Hey you guys, I'm just going to drop a quick trendline liquidity video for you today. We're going to keep this one short and sweet.
There are a lot of people in the Forex market that use trend lines as a way to enter trades. And those can be pretty profitable on the higher time frames if we understand true price action. But for people that get caught up in trading trend lines, they don't understand that all of this is basically market structure for price to take all of this money out, because when we think about liquidity, what it means, you guys, is there are people that are constantly putting their stop losses over and over and over again on this trend line, and that creates a ton of resting stop loss orders directly above this trend line, which is exactly why it's called trendline liquidity. So you have all of this money stacked above this price action. Now, the interesting thing about what happens when price finally decides to take all this out is that price will typically do something like this, and then boom. It will not stop, it will not range, it will just absolutely wipe it out. Now, the reason for this is this has to do with the mitigation that we have been talking about. And when price is creating a trend line, you guys, especially in the form of more of a compression, okay? We are not really talking about trend lines that might look a little more like this, and they're really spaced out. Because what happens with these trend lines is that there's still unmitigated price in each of these areas. Therefore, what typically happens here is price will come up, and as it gets into these zones, it will make pullbacks into these order blocks to continue making a pullback into these order blocks and then continue. Okay? This here is trendline liquidity from a compression standpoint, that, as you can see, there is absolutely nothing in this price action that is left unmitigated. So if you have a trend line that looks like this, there is absolutely still liquidity all resting above it, because people are absolutely still putting their stop losses at the trend line. However, because there is unmitigated orders, you can actually use these areas to short back down into the demand that caused it. So as price is creating new demand into it, we can short down with the understanding that most likely, because the entire trend line is not mitigated, then price is going to continue its block flow until this is all gone. Whereas this price action over here, price will come down and just boom, wipe right through it. And we can use both of these models to our advantage. So let's get into some charts and I'll show you. Okay, so we're going to be going through different examples of trendline liquidity. Now you're going to find trendline liquidity on every time frame. Okay, so this is the weekly, very simple. I'm going to give you a couple examples of the two scenarios that I mentioned to you. Well, if we look right here, this is a trend line, and as you can see, price ripped right through it because there was no unmitigated orders. Okay, now I would say that maybe the top here was unmitigated, but let's see how this looks, you guys, on a different time frame. This is a compression trend line that we can start to look at, that every single one of these areas, okay, every single one of these highs was mitigated by a pullback. Other than, well, this one was mitigated here. Didn't quite reach the top here, but it did mitigate some of that area. Therefore, when price came in here, it just absolutely skyrocketed through it. Okay? Let's look at a couple other examples. Here's another mitigated trend line. And price, boom, basically almost no interaction and just ripped right through it, finding the unmitigated POI inside of this price action. Okay? Let's go here. This trend line. Let's go through all of the price action, right? Price went down, pull back, down, pull back, down, pull back, down. It didn't quite mitigate this guy. And we go down, pull back, mitigating this leftover, pull back, and then it ripped right through. All right. So the last areas that were left unmitigated did have some reactions. You had a bit of choppiness here as price got to the higher area that was a little less mitigated. But nonetheless, all of the areas of price that were mitigated prior were just, it is absolutely ripped right through those price actions. Now, let's go and look at some examples of trend lines that, for instance, didn't have compression trend lines. Okay, so if we're talking about this trend line here, look at how much price action, guys, not mitigated, not mitigated, not mitigated, not mitigated, not mitigated, right? So we can look at each one of these zones, and what typically, guys, happens, as I said, with a trend line is that as the trend starts to break down, price will mitigate each of these zones, but these are pullback zones. They are not reversal zones. So price ends up pulling back to mitigate unmitigated order blocks that are making bearish market structure, but they're not actually reversing price to take the price to go bullish again. Therefore, what we should start to understand is that as price is trending, then when price breaks and as price is trending, these zones to the left are not reversal zones. They are typically mitigation zones. So then when price gets to the bottom of its mitigation point, you're either going to have a bigger reversal if price wants to go bullish, or it's going to mitigate the entire trend line. Okay, the entire structure, because this entire structure is actually a bigger one candle push. And price might be doing something like this, guys, creating a candle, and then this candle is coming in bearish to mitigate all this imbalance from this candle, and then all of a sudden this candle will be bullish like this on a higher time frame, which is what this overall price action is telling us. Okay, so let's go to a couple more examples, you guys, and look at trend lines. Let's go to the 15-minute. So here we are again. This is recent price action in May. We have a trend line. We have a higher high. Price has now started to mitigate. Now, in each of these instances, you guys, where this was unmitigated, you can see that price retested, little pullback, tiny little pullback here on this guy, but just goes all the way down to this big unmitigated zone right here. And then this gives us an absolute insane, and again, this is the 15 minutes, so insane pullback to some sort of unmitigated area here, and then just keeps going. So now price is pulling back here. So what could happen? Price could go like this, you guys, or price could go here, or price could go here. We have three options of which we can look for, and ideally you would be looking for buys around here or here, and then, or you're looking for a buy to clear out this high. Okay, so let's go through some other examples. And what I want to start to focus on, guys, is how you can start to see liquidity trends, liquidity trend lines on the lower time frames. What do I mean by that? Well, let's start looking at the wicks, okay? Like these two wicks here, right? These two wicks here with no wick here shows me that this here is a trend on the lower time frame, and there was unmitigated price action just below that area. And why do you think price reversed from there? Because this was all mitigated price action. Price wanted to take out the trend line liquidity, and then it wanted to make its pullback. Okay, just like we can see here, this was a trend line. Okay, on the lower time frames, those wicks represent mitigation. When you have multiple wicks forming like this, that is creating candles that are all making pullbacks. They're all making pullbacks in a compression standpoint. Therefore, there's nothing left here other than the imbalance above those wicks for price to really start to roll over or do something of interest. And we can pair those with also other POIs like our buys to sell that are order blocks, and we can look to take these areas short to mitigate their own internal liquidity and trend lines. Okay? So let's just do a couple more examples, and then we'll leave it there. Okay, so this is kind of an interesting example because this here was a trend, right? And each one of these instances, you guys, and this is what a lot of people do, guys, when they're trading. They are looking at these areas thinking price is going to reverse. When if you watch my Don't Look to the Left video on YouTube, each one of these areas to the left, as you can see, guys, yes, it causes retracement trades. But we have to understand that, yes, this is a 15-minute. This is an absolute monster of a trade if you caught this on the lower time frame. But look what happened. It's a retracement that still ended up creating bullish market pressure that ended up making a new high. Therefore, it didn't really reverse price, right? It didn't really reverse price in terms of our bullish sentiment of creating this new trend. Most likely, price will continue to mitigate all the way up to here in order to reverse. This then coincides nicely with a daily POI, because if you look at the daily needs to mitigate what? All of these little pullbacks, guys, all of these little topside wicks are part of the higher time frame mitigation trend. Therefore, price is most likely going to do something like this, and then it could do that to come back and fill this imbalance here. Okay, and we can use these time frames to our advantage if you understand what these candlesticks are indeed doing. Okay, so I'm going to leave this video there.
I hope you found it helpful, and hope this kind of opens your eyes to trend lines and how you can use them to your advantage.